Hello, everyone. Today on the final bar, I'm joined by Frank Cappelleri, as the technical analyst at Instinet, coming to us from the New York area. We'll talk about this market environment overall. We are again in sort of this digestion phase, right? We talk about previous weeks and months even being the big meal, and now we're sort of in the heat of the digestion phase, where you process that previous gain, and then the question is, does this pullback turn into something a little more significant, or is this yet another Bible dip in a year of Bible dips? Ladies and gentlemen, this is the final bar. Hey everyone, this is Dave Keller, Chief Market Strategist at StockCharts.com here in a sunny Redmond, Washington. Welcome to the final bar. It's great to have you with us every weekday after the close as we break down the activity in the markets using the power of stock charts, the power of technical analysis, behavioral finance, investor psychology, thinking about themes like trend, momentum, breadth, sentiment, but most importantly, price, the message that the markets can give back to us in terms of where the trends are evolving. As we've talked about many times on the show, I think your goal as an investor should be threefold. Number one, identify trends where they're at. Number two, follow those trends, leaning into what's working and leaning away from what's not working. And then the third one is anticipate when those trends are exhausted. And really, in the last month or two, last couple of weeks, even, I think we've seen this potential transition as you've identified, or we've identified this persistent uptrend in stocks. We've talked about following that trend as it continues higher and what lines in the sand to pay attention to. But now, once again, we're teasing that 50-day moving average, which has served as consistent support through the entire year. Now, as one of my mentors, Greg Morris, said, all new highs are bullish except the last one, right? So every new high is more and more positive, and that's absolutely true. But in the end, right, at some point, the uptrend is exhausted, and having some sort of risk assessment, some sort of line in the sand clearly defined so you can identify when that trend is exhausted is super important. Coming up, we have a great guest today. Frank Cappelleri is a fantastic technical strategist. It's really, really good to have him on the show. Next week, on Tuesday, the 21st, we have Tony Zhang, who's the chief options strategist at Options Play. On Wednesday, the 22nd, Jay Pettit from Charts Avenue. On Thursday, the 23rd, Katie Stockton from Fairlead Strategies in Connecticut. Then coming up the next week on September 28th is Alessio Ritigliano. Alessio is a cryptocurrency expert over at Wyckoff Analytics. We were originally had him on this week. We had to reschedule him, and I'm excited to bring him on the show and hear his take in an incredibly volatile asset class for sure. Also, as a reminder, coming up this weekend on Saturday, September 18th, all day is the annual conference of the Technical Securities Analysts Association, the TSAA. This is a technical analysis association based in San Francisco. Many institutional investors and long-term investors in the industry are in there, but also a lot of individual investors as well. It's a really good community comparing notes on charts and elsewhere. This Saturday, a great event with Craig Johnson from Piper Sandler, Ari Wald from Oppenheimer, Arusha Paris, our friend from IBD, Chris Kimball from Kimball Charting Solutions. Really great speakers, a lot of good content there. So go to tsaasf.org for more information on that event coming up Saturday, the 18th. Let's continue on with today's market recap. So as I mentioned, right, we've been in this digestion phase. Yesterday really pushed to the upside through the course of the day. So 2 days ago, right, Tuesday, you have the big distribution leading right to the 50-day moving average. Yesterday, you sort of bounce up. Earlier in the day, it actually looked like the distribution was going to continue. We were going to just plow through the 50-day moving average. Buyers come in around 11 a.m. Eastern and push us up toward the close from yesterday, and we finished up just a little bit below the zero level with the S&P closing just above 4470. Elsewhere, we have mid caps and small caps really all around the same level. No real, significant outliers, I think, there of the three major cap tiers that we follow. It's worth noting that the NASDAQ and the NASDAQ Composite, NASDAQ 100 and the NASDAQ Composite both finished a little bit above zero, and the VIX is back above 18, around 1870. Other asset classes, very quickly, you have interest rates continue to increase through the course of this week. Yesterday, the 10-year yields going a little higher, getting above 130. Today, following through a little bit further to close around 133. That's using the dollar sign TNX, which is the main 10-year yield index that we track. The TLT, which is our bond price sort of proxy, good indicator for bond prices, down about 0.5%. The dollar index higher today by about 0.4% using the UUP. That's what's causing some red over here with gold and silver actually going lower. The GLD really gapped down today. It was quite a distribution. If you look at a chart of the GLD, I think the sell off, the direction of the sell off or the direction of the movement doesn't surprise me a ton because most recently we talked about the GLD being unable to eclipse its previous highs. And let's stop talking about the chart and actually look at the chart as I'm describing. I'm thinking in my head. Let's bring it up visually here. So this is today. This is the gap down from yesterday. We closed around 168 or so. Today we gapped down and closed about middle range for the day around 164. So two observations that I would make of this, maybe three. Number one, remember we talked about this chart when it regained sort of that 170, 150 range, and that was the high from July and August. So anytime you have an established resistance level, we trade back up to it. I think you want to pay it special attention, right? Because this is the opportunity for the chart to really change, or what we call a change of character, where it's in one phase, a negative phase, and all of a sudden it transitions to more of a positive phase. It failed in that attempt, right? The day after we reached that previous high, we came lower, gap down. So the fact that we gap down today, is certainly sudden and potentially unexpected. But I think the direction, the path of least resistance being down doesn't surprise me, given the failure to eclipse the high there. What's interesting now is we're back nearing that range, the lower end of the range for gold. So the last couple lows for the GLD have been right around in this area, sort of in the 161 to 164 range. We're sort of right there. So we're at the June low and the August low in the general area there. But below there, you have support around 157, 158. Those are the lows from March and April, which actually line up with some Fibonacci retracements from about a year previous to that, looking at the big long-term structure. So, the distribution in gold apparently continues. We are very near a lot of key support levels. I wouldn't be surprised to expect gold to find support here, and looking for some sort of upward movement. I would keep an eye on the RSI. I think it was worth noting that the RSI really was unable to get above 60 on this rally here, and that is more characteristic of a bear market phase where the whole range of the RSI kind of comes down a little bit. So if we do rally and retest those levels, I would be watching resistance, watching the RSI, and see if those things are able to change from this environment we've been in, which is more of a distribution phase overall for gold. Looking at a chart of the S&P 500 again, I think we're in pullback watch. Pullbacks, I guess, happened, right? Depending on what you define that. We're sort of 3% off of all-time highs. All-time highs were, a week and a half ago, so not too far off of the 45.50 level. But at this point, we're sort of right at that point. We've talked about some of the guideposts to be looking for. The 50-day moving average, certainly a widely followed level of support through the course of this year because it's been so consistent. We've closed below the 50-day moving average 1, 2, 3, 4 bars the entire year. And literally every single one of them, we've closed back above it the immediate last day. So if you're looking for a measure of this uptrend, that seems to be as good as any as I've seen. And again, that seems to be holding so far this week. At some point, it doesn't hold. At some point, we close below the 50-day, and then we're unable to regain it the next day. And if that would happen, then you'll hear my voice start to change a little bit from a healthy pullback with an uptrend mode to more let's think about risk assessment and focus on downside potential and what lines in the sand we want to make sure that we have for the chart of the S&P, but for other charts as well. Finishing off our market recap here in terms of sector distributions, consumer discretionary and real estate, really the only two that finished above the zero level with any sort of significance. On the downside, you had some of the cyclicals, energy, materials there, utilities, and industrial. So this was not a market down, and it was defense over offense necessarily. A little more mixed. Consumer discretionary being at the top of the list is important. Energy is an interesting one because we've talked about how different that chart looks than some of the other charts that we've talked about. And you've seen the lower lows in the XLE and some of the major names in the sector, and potentially rotating higher. Days like today don't make it feel like that's actually in the cards. But remember, a day like today is part of a larger context. Let's focus on the big picture and appropriately put today into proper context. A couple of stocks to just think about that are rotating to the upside pretty nicely. And this is my public service announcement that at any day, anywhere, there are some stocks that are making new highs, and that is just a true part of the market. I'm reminded of years of reading the IBD back was in a daily newspaper. I was in New York and I'd buy it from the same newsstand every morning and I'd open it. They would always have a bunch of charts that were going up and to the right, regardless of the market environment. This is through, 2000 to 2001 through the 2007, 2008 period. There always seem to be stocks that are working. It's just a question of making sure you identify those opportunities, right? So on a day like today, where the market's pulled back a little bit, a couple percent, you're looking at the 50-day moving average. There's a chart like HCA, which is making a new swing high today, right? Rallying and gapping up in July, sort of in this sideways consolidation sort of period, but managing to push to new highs up about 2% today. That is a little bit impressive. What's much more impressive to me is when the relative strength is making new 12-month highs, even more than that. So, overall trends like that tend to persist until proven otherwise. I'd expect the path of least resistance on a chart that like that to be positive. There are also a group of names that are actually rotating from a distribution phase to an accumulation phase. Disney, you can make an argument for being in a similar pattern, bouncing off of its 200-day moving average. If you can continue that rotation to the upside, Etsy maybe making that rotation this week, where you had the distribution February, March, April, May, sort of sideways and finding support, starting to make some higher lows, but now all of a sudden making some higher highs as well, breaking above the previous resistance around 210. We sort of tested that and rotating higher. So the scanning engine on StockCharts is a really good place to start if you're not able to find these sorts of ideas. They're out there. I screened this morning for stocks making new 3-month highs and 3-month lows, and some of these names bubbled up on those screens. So make sure that you take the time to focus on opportunities. In any market, in any environment, there are stocks that are breaking out and breaking down. It's all about being able to identify those opportunities. We'll take a quick break. We'll be back with my guest, Frank Cappelleri. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close for our show as we recap the activity of the day through the lenses of technical analysis and behavioral finance, focusing on the trends and where the opportunities might be. A couple quick announcements before we get to today's guest, Frank Cappelleri. Number one, we love to hear from you, particularly questions that are coming up as you are analyzing your own charts. We can share charts and highlight ideas for you, but hopefully what we're able to do over time, given the opportunity, is to point you in the right direction. Questions on technical indicators, on particular tickers or ratios that you're looking at, just market history and market dynamics, and trying to make sense of the markets in uncertain times. You can get your questions to us via email. That's the best way. The Final Bar at StockCharts.com is our email address. We are on Twitter at FinalBarSCTV. We're on YouTube. Just go to the Stock Charts channel, put a comment below the video that you're watching. We'd love to hear from you and hope to answer one of your questions on Friday's mailbag segment. Also, go to StockChartsTV.com. You can use your email address, set up a free account. You can start watching all of our great content immediately from our website, also from your mobile devices. Great shows like the Final Bar and many others that we have going on every trading day. Special events like the Pitch, our mid-year market outlook, our year in review that we're just starting to plan out now, and so much more. Go to StockChartsTV.com or on the App Store on any of your mobile devices. Just search for StockCharts TV on demand. I want to welcome on today's guest, Frank Cappelleri. Frank's the chief technical analyst at Instinet, based in the New York area. Frank's been on the show before, always does a great job bringing charts that make us think and put things into proper context. Frank, welcome back.
Thanks so much, Dave. Nice to see you.
It's good to see you too. So we have this situation where the market is in yet another pullback. We've had a number of these through the course of the year. You're starting us here with your S&P 500 chart. What are you seeing when you're looking at this?
Well, Dave, you did a great job explaining how the 50-day moving average has held that support. I think it's just as important to realize or think about how the market has set up to get back down to that line. And you can see we've highlighted all these potential topping formations along the way. Now, we talked about this before, but I like to take a look at the market from a pattern perspective first. So generally, if the market's trending higher, you would think that bullish patterns have been working and bearish patterns have been failing. And that's exactly what's been occurring now. And we can see along the way, there's about 9 topping formations there. Some of them had a temporary breakdown. Some of them hadn't either. But every time we see a bear trap develop, a strong reversal, and a move to new highs once again. And so I think we have to look at this and realize, again, there's an average down below it, but really it's a matter of patterns playing out or not. And if we finally see a downside target hit right around 4,400 for me now, I think that's when we can take a step back and think maybe the tide has changed a bit. At the very least, a character change, that we're coming out of an uptrend that has been very steady to maybe something different.
I love that description of tides, right? We sort of have these waves going backward and forward while the tide certainly seems to continue to go higher and higher. Your second chart, Frank, is looking at the days without a 1% gain, which is an interesting look. Talk us through this one.
Right. So looking at this at first glance, you can make the case that the market is just waning on the buy side, right? Haven't had a big advance in quite some time, but as we know, that tends to happen when the market tends to mature from a very powerful move to an extended uptrend. And I think we get a better perspective if we take a look at the last few years on the next two charts there. And two things jump out at me when I see this. One is that you've had moves or days without a 1% gain extend much longer than we had already. And when it happens, it tends to happen in clusters, as we see there, right? The first chart goes from the end of 2016, 2018. It's really just one after the other. We know that it was a really strong move, but really with low gains the whole time in 2017. And then in 2019 to 20, same type of thing, 43, 40, and then 70. So as we know, eventually you get to the point at the end of these trends and it gets very extended and you get a lot more emotion, big declines, big gains, and we see what happened in early 2018 and 2020. So at some point it's going to change, but I think we can't jump ahead of it at the moment because, again, these tend to lead and we have other instances before the end is near.
There's a great market history lesson as well, Frank. Just look at the number of 1% gains you have during bear market phases or consolidation phase. Those are the biggest bounces in the chart on both sides, right? The volatility seems
That's
to
right.
step up. Now at the end, where energy is a sector we talked about a lot. I mean, it's been one of the underperforming sectors for sure. What are you seeing in this sector opportunistically?
Well, I think this is a very important one to look at because it shows that there's opportunities across multiple time horizons, right? And that's what we go through in the CMT process a lot too. Just you can use this depending if you're, short term or long term. So initially, we had the daily, you know, uh, bottom formation breakout from a few days ago, pull back today, but still you can see there's a bullish setup and call it inverse head and shoulders pattern. Now, again, when bullish patterns are working, that means bearish patterns typically are not. So if we go to the right there, we see that when we had this rally from say the beginning or middle of August till now, that was able to then bring up the market that was potentially breaking down below a support zone, below a 200-day moving average as well. So a bear trap developed. Going down to the bottom left, that coincided with a weekly bottom information being able to keep intact, right? We had the big breakout at the beginning of 2021, and it was tested multiple times. Right? It looked like it was going to break down. It did not. So we can keep that target up in the high 60s in place. And then finishing up on to the bottom right, we have a monthly potential cup and handle pattern that hasn't even broken out yet. So again, you look at this, at least I look at this in terms of patterns, right? You have smaller bullish patterns continuing to work out. It leads to additional bullish formations forming, which then form longer term patterns to leverage. And that's how, a previously very tough market can turn.
It's a great example and a beautiful use of stock charts. I have to compliment you on how you're using it. I'm humbled when someone comes on and uses the platform a little better than I have. That was beautifully articulated. We only have about 30 seconds left, Frank, but I'd love to think, given this environment, right? Energy's, potentially starting to look more constructive. You have the S&P that, still within an uptrend overall. Is there a particular signal or level or pattern or breakdown or something that would tell you that this is now starting to change, right? Is it a failure in a key group? Is it a breadth indicator or just a level on the S&P that would tell you we need to revisit the bullish thesis, broadly speaking?
Yeah, good question. I think one area or one ETF we should look at is the XLC Communication Services ETF.
Mm.
If you look at both of those side by side of the S&P, nearly identical in terms of how they rise, in terms of respecting the 50-day moving average. And we know that a lot of those components used to be in technology, a lot of the bigger ones. Now in the XLC, as you know, they're reporting along with everyone else in a number of weeks. So considering that we typically have positive seasonality for the fourth quarter, and these are reporting, and the XLC looks so much like the S&P 500, I think we're going to get a very good clue of what's coming in the months ahead by how those do.
It's a great take. Frank, listen, it's always good to have you on the show. Really appreciate you sharing some ideas with us. Stay safe, be well. We'll talk to you again soon.
Thanks so much, Dave. Talk to you soon.
That's Frank Cappelleri. Frank is the chief technical analyst at Instanet in New York. Does just such a great job of just talking through and making making it sound very simple in terms of how to break down this environment, how to make sense of it. And again, what I've learned from working with people like Frank and successful institutional investors is being able to keep a proper perspective. You're going to have movements, days that are up and down and plenty of fluctuations. Having a proper long-term perspective, seeing how it fits into the big picture is so valuable. It was great, great take from Frank Cappelleri. Let's continue on. Our next segment is called Getting Sentimental. A lot of the weekly sentiment data is updated Wednesday into Thursday. It's a really good opportunity to review some of the sentiment indicators. Actually, one of them in particular, quite a move this week, which we're going to focus on here in a minute. But we're going to start with the VIX. The VIX is often, I think, unfortunately called the fear gauge. While yes, in general, markets sell off, there tends to be a spike in uncertainty and a spike in volatility, and that's reflected by the VIX going higher. I think we like to oversimplify this just a little too much. I'd remind you that there are plenty of times when the market goes up and the volatility can increase as well. There are times when the market goes down and the volatility can decrease. It's not a perfect inverse correlation. Having said that, you'll note if you look at the last 6 months or so, when the VIX gets above 2021, those are the times when we're in the pullback phase and we pull back to that opportunistic low. One of my guests a couple of weeks ago particularly talked about the VIX being above 20 and looking at the June, July, August monthly period. Now, this has coincided with options expiration, which happens to be tomorrow. That's this Friday. So we're lining up potentially for a very similar about monthly bottom from May, June, July, August, September, the third week of the month. The VIX gets above 20. The stock market pulls back. We get buyers to come in and we push higher. And I have no problem assuming that that's going to happen, but I also have very much a problem with you assuming that's going to happen and not planning for an alternate outcome. One of these times that pattern doesn't work. And that's the one that I think if you're prepared for it, you're going to navigate it much more successfully than if you're not. So, what is the scenario? What would the VIX look like on a steeper sell-off? And I think eclipsing some of the highs from the last couple months would certainly tell you the conditions are changing. That's why the May low, to be honest with you, looked pretty severe, right? Because you had a big spike in the VIX. You see how significant that is relative to some of the previous moves. And remember that the VIX is not necessarily bound, right? Theoretically, the VIX can go really, really high as we saw in the February, March 2020 period. So, 20, 25, 30, 80, these are not hard and fast limits to the VIX. Volatility can certainly increase in periods of uncertainty. But at this point, it's looking very similar to some of these previous pullbacks, unless we would get a rotation back higher and get the VIX pushing to the upside. Now, this is the chart I alluded to moments ago, the AAII survey. As a reminder, this is the American Association of Individual Investors. This is a weekly sentiment poll that's sent out to a subset of their membership, and you vote bullish, bearish, or neutral on stocks for the next 6 months, if I remember right. Last week, and really for the last couple of weeks, it's been around 40% bulls, and the number of bears has been sort of in the, we'll call it 30-ish range, 30, 35 percent range. And last week was the lowest number of bulls that we've had in the last 6 weeks. This week, actually, just today we got the updated numbers. The bearish reading is actually the lowest it's been since all the way back here in June of last year, which is pretty significant. So we're less bullish than we were here in September in any of these other pullbacks, which are fairly significant, and much less bullish than we were in some of these previous pullbacks here in the last 6 months or so. So a big drop in the percent of bulls. The bearish reading is the lowest it's been actually since September, October of last year. We're almost just barely undercut the value from January of this year, which means we're going back to this consolidation period, this real long-term digestion period. I think back in September and October of last year. So what's interesting is from this indicator's perspective, we are really low, right? We're the lowest we've been in quite a while. If you go back to where we've been this low before, it's been quite a while since we've been to these sorts of to these levels, and we're back to sort of more of a significant pullback type of environment. The difference between bulls and bears is now the most negative it's been since back here last September, and again, this is during that same period. So the sentiment using the AAII survey has taken a significant turn this week, looking a lot more like a deeper correction than some of these previous pullbacks that we've been. So I hate to say this time is different. I won't. I'll try not to say that, but I think I just did. We're starting to see conditions that are unlike some of the pullbacks that we've had. When we think about this garden variety pullback, it's starting to look a little different in terms of the sentiment reading. Where you've not had much of a change in the sentiment reading, with the name exposure index. This is asking money managers where they're allocated with equities. Long, leveraged long, flat, short, or leverage short, and you can vote within that spectrum, and it's netting out to around 87% bullish, which is really, if you look back at the series, this is sort of an average bullish reading. This is not euphoric. This is not anywhere near, too light relative to normal. It's about a normal exposure to the equity market. So no real change there in the name exposure index. The RIDEX flows, by the way, remain at the most negative that they've been really in the deep history of this series. Now, the RIDEX family has changed. How investors use them has changed. So I think that's part of what you need to think about. But the fact remains, it's the lowest level that it's been. If you don't understand the RIDEX flows, by the way, you can look up the Chart School article, which we describe, and also Aaron Swenlin from Decision Point posted a great article about that just recently, explaining what that represents for euphoric sentiment. That is our segment, Getting Sentimental. We need to wrap the show. Go to the 3 in 3, 3 charts in 3 minutes. Here we go. Chart number 1, we just finished our look at sentiment, looking at the AAII survey. And again, what I've mostly looked at with the AAII survey is extreme bullishness. For me, that has been the reading that has told me, investors are euphoric. If you put your Humphrey Neal, the art of contrary opinion on you, you can imagine that means you need to go against the crowd that is now overly optimistic. That happened back here in March, April, May, right? That it's been sort of successively negative. So every new high over the next couple months, we've made less and less bulls in this rating. And I think that's the story now is, the market going higher on, weakening breadth, on deteriorating sentiment, and all of which sort of points to the fact that we're at the latter stages of this. But this, in terms of the percent bulls being the lowest since a much more significant pullback or a corrective period in terms of time and price, is certainly something that caught my eye today. Chart number 2 or item number 2 is Etsy. And again, not that this stock in particular is the perfect chart, but it's a pretty compelling illustration of the rotation from bearish phase to bullish phase. And again, when I talk about bearish to bullish phase or distribution to accumulation, a couple things that I would point out here. Number 1, Charles Dow said a downtrend was a pattern of lower lows and lower highs. You can see how that happened first quarter into second quarter, but look at how that now changed, right? We're now making higher highs and higher lows. And I think the breakout today just continues. It perpetuates that uptrend that we've seen over the last couple months. The RSI is really interesting to look at here as well. Look at the range in the RSI, sort of December, January, February, March, even into April of this year, right? Look at how the RSI became overbought when the market moves higher. It remains above the 40 level when we pull back. That all changed here in April into May when we broke down and you saw the range get lower, right? We actually broke below 40. Now we're back once again in the bullish range with the RSI becoming overbought on an upswing, remaining above 40 on a pullback. That's the sign of a stock that's rotated from a bearish phase to a bullish phase. And so I think the breakout today is an interesting one. Love to see some further follow through, which continues that trend. But I think if you look at momentum, you look at the relative strength, which is making a new 4 or 5 month relative high, the price making new swing highs, higher highs and higher lows. All of that is the sign of, or are signs of constructive price activity. Finally, materials. When I screen for new ideas, which I do a couple times a week, looking at 3-month highs and 3-month lows, the 3-month lows today were clustered in 2 sectors in particular: healthcare and materials. And in healthcare, you had some pharma names like Merck and BMY and others that were coming down, but also other groups as well. In materials, you had quite a few. The gold stocks, a lot of them breaking down. Newmont, GOLD and others are kind of breaking down through short-term support. The materials sector as well below its 50-day. This is one of a number of sectors that are testing their 50-day and so far in the last couple of days actually breaking down through it. It's worth paying attention to some of these cyclical sectors and seeing if they're able to hold moving average support. The materials sector so far does not look so good for that. Breaking down through the 50-day, testing the swing low from August, and potentially making a new 12-month relative low, which is where I'll be looking now on the XLB. So this is one chart that represents a number of them, I think, starting to show some potential weakness underneath the hood. Folks, that is our show for today. Thank you so much for joining us every weekday after the close as we break down the market activity from a technical perspective. Special thank you to my guest, Frank Cappelleri, technical analyst at Instinet in New York. Always great to have him on the show. For StockCharts.com in Redmond, Washington, be well, stay safe, have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.